Hello and welcome to the McLean Syndicate Commodities Outlook for September 2025. Today we're going to look at trends in energy, agriculture, precious metals, and industrial metals. We'll start with energy. Overall long-term trend continues. Oil and coal being replaced by natural gas and renewables. Even with increased demand from China and India, we see fuel efficiency and EV adoption dragging on oil and coal demand. Geopolitical shifts always hovering over these markets in terms of Middle East and now with Russia sanctions and also tariff policy in the U.S. So that's driving a lot of the dynamism in the market. Global oil market, again, Russia sanctions directing flows to India, China, and Turkey. Um, Demand expected to plateau by 2029, given EVs and renewable energy growth. Some new markets coming online in terms of supply, Africa and Latin America mainly, Ivory Coast and Senegal specifically producing some of their first oil and boosting their economies as a result. Brazil, Guyana, and Suriname increasingly investing in new oil projects, which may further dampen prices in the coming years. Natural gas market, we see the huge peak here in the price after once the start of the Ukraine war. That price has come down a bit. Lots of investment in LNG export capacity by the U.S. and Qatar, trying to fill that need for Europe as it diversifies away from Russian gas. Again, Middle East tensions and tariffs also looming over this market. In terms of alternative energy, we see nuclear renaissance very obvious in the price of uranium, running up over the past few years. Some other issues in terms of supply constraints in Africa also driving up that price. Meanwhile, price per watt of PV panels continues to come down, making it more competitive, and the clean energy boost to prices in the metal sector, which we'll get into in just a minute. Agricultural trends, high level, we're seeing lots of ag tech innovation, both in terms of biotechnology, increasing crop yields and productivity in the digital space, investments increasing everything from supply chain efficiencies, pest control, um, delivery and production supply issues. So lots of productivity increases in the sector, eventually coming through to lower prices for the consumer. Climate having the opposite effect, droughts in Africa and Americas driving up prices as supply is constrained. Demand for organic and non-GMO food increasing globally. Tariffs and China issues also hovering over these markets. In terms of the big three crops, we've got corn, soybeans, and wheat. Corn and wheat at their lowest price levels in about 5 years, given strong supply. Um, we see a lot of these northern regions increasing supply, partially as a result of climate change, Russia and Europe specifically. Soybean production up 2%, but consumption up 4%. So we'll keep an eye on these markets, but fairly steady lately. Cattle, on the other hand, we're seeing the lowest population in the U.S. In more than 50 years. Global herd rebuilding going to take a couple of years, so we'll see elevated prices most likely for the next couple of years in this market. We've also got rising feed costs, inflating prices, and again, tariff issues. So lots of dynamics here in the cattle market. Cash crops, palm oil, huge increase in demand from China and India, also to a lesser extent from Indonesia. However, price staying fairly steady over the past few years, unlike coffee, which has nearly doubled in the past 18 months or so, from about $2 a pound to $4, almost $4 today. Brazil and Middle East dealing with weather issues, driving down supply, driving up prices. Cocoa also facing drought and other issues. Ivory Coast and Ghana providing 65% of global supply. Some other regions trying to step in, but that's going to take a while to ramp up. So we're seeing huge run up in prices over the past couple of years. Come back down somewhat, but still more than triple where they were in 2023. Cotton, on the other hand, very low pricing at 65 cents. Weak demand, high supply. So definitely a buyer's market there. Milo continues strong growth. This crop is favored because of climate change. It's drought resistant. Supply is concentrated in the U.S. and Australia, used for livestock, but also for biofuels. So this crop has a bright future. It seems $12 billion market size expected by 2030. Moving on now to precious metals. Um, Lots of issues with critical minerals and strategic minerals. Basically, the US and Europe and others trying to diversify their supply chains away from China, which is not necessarily the source of a lot of these minerals, but really dominates in the refining capacity for these metals, which may come from other areas around the world. As an example, we look at cobalt and platinum. DRC supplying about 80% of cobalt globally. South Africa and Russia supplying platinum. Both of these minerals in high demand because of EVs, electronics generally, um, but a lot of the refining capacity again in China. So aiming U.S. and others aiming to diversify that supply chain. Gold really experienced a quite unprecedented run up to more than $3,600 an ounce now. You can see the flight to safety from 1970s looks like a blip here on this chart. 2009 run up we see, and then commodities prices coming back down after that. They stayed elevated for a couple of years after the crisis. Some of that early 2000s run up is explained by China's increased growth, but definitely in the past few years, we see inflation concerns and geopolitical concerns driving up the price of gold. Silver also having its highest price in more than 10 years, also becoming an investment metal, so also experiencing high demand. Cobalt markets, as we mentioned, DRC controlling about 80% of global supply. Um, that is oversupplied now. So, from a price perspective, doesn't look like too much of a strategic risk. But again, China controlling 75% of global refining and is heavily invested in these DRC and Indonesian mines. So, an interest on the part of the US and others to diversify that supply chain. Cobalt, of course, used in lithium ion batteries and a range of other electronics. So, in high demand, but supply looks more than adequate at this point. In fact, DRC cutting supply to try to shore up that price, which came down quite a bit since 2022. The shift from internal combustion engines to electric vehicles is quite obvious here in these price of these two metals, platinum versus palladium. Palladium used in ICE vehicles, platinum in EVs, and we can see what's happening. Palladium price just keeps falling. There's oversupply from South Africa and Russia. Meanwhile, platinum facing deficit in supply and increased demand. So interesting dynamic comparing these two metals in the industrial metal space, looking at some of the macro trends, copper really demanded for a range of EV and renewable energy supply technologies, batteries, lots of supply constraints in terms of permitting delays, regulations, environmental concerns. China, again, supplying 60% of these metals, including the refining. So we'll see how this plays out in the individual markets. With steel, steel price coming down dramatically over the past few years, and investment by Nippon into U.S. steel expected to bring some efficiencies and further likely to decrease the price. We've also got production increases basically around the world. So again, more of a buyer's market here and less concern, I'd say, about the critical mineral issue with steel. Aluminum in high demand for all of these different energy sources, traditional and renewables. Tight market structure, but again, price fairly tame over the past few years. Demand drivers similar for the other metals in terms of EVs and renewable energies. Inventories are at a low. Tariffs may have an effect, but overall, price looks fairly steady. Copper market whipsawing a bit earlier this year based on tariff policy. So once it was announced that tariffs would not be applied, you see the huge price drop just a couple of months ago. Major projects supposed to come online, but some delays, so helping to push the price up in a longer term sense. Surging demand from AI data centers, EVs, renewables. So We'll have to see how this plays out. Obviously, policy having a major impact on pricing, and the need for some caution on policy announcements and implementation there. Lithium, a bit of a scare in the pricing for buyers a couple of years ago. That has come way down. Again, the concern being 65% of refining is in China. Um, However, it doesn't look like the price is really a danger to buyers at this point. But again, in terms of hedging, U.S. and Europe and others looking for some other markets, especially in terms of refining. We are the McLean Syndicate. We're a boutique financial advisory firm based in Washington, D.C., advising on capital raising, M&A, project finance, and some other issues. We work across and geographies, both in developed countries and in emerging frontier markets, specialties in real estate infrastructure, agriculture, finance, and other areas. My name is Brian Desilets. If you are in need of our services, please don't hesitate to reach out. Thank you, and we'll see you next time.